Mark here from Success with Options. In this video, I wanted to cover a topic that's a little bit different, and that is I want to spend some time talking about portfolio management. Now, this is something I haven't spent a lot of time talking about on the website. I've specifically talked more about managing individual trades and how to decide when to get in, when to get out, and so forth. But I want to talk a little more about the portfolio as a whole and how we decide how we might want to put another position on. In other words, what kind of a position might we want to put on given what we already have in our portfolio. So I'm going to start going through the Thinkorswim platform and show you some of the tools that we have at our disposal to be able to do this kind of analysis. First of all, I want to draw your attention to the individual positions that we have on. We have a diamond iron condor that I've recently adjusted. It was a full iron condor and we bought back the put spread, and then I just recently added a single contract put spread to balance the position out a little bit and add some positive theta while adjusting the position to be slightly more bullish. I also have a diagonal spread on the SMH, and I just recently rolled the September 26th position to an October position, and I have a calendar position on where I recently rolled from an October position to a November position. So the combination of these right now, I see that I have a positive delta of 5.75, but what is that relative to? It's really not compared to anything. So in order to get a good idea of how we could measure the overall effective delta relative to a particular index, we need to add a beta weighting component. With this little checkbox, I can add a symbol that I can compare, and I can literally compare against anything, but we typically want to compare against some particular index, and I like to use the SPX, or really the SPY, for a couple of reasons. One is it's a very broad index, and second of all, many of the components of the SPY are indexes or sectors that I currently trade, whether it's semiconductors or the SPY itself or some such thing. So it just makes a good relative comparison, and it helps me know how I might adjust my position by using other SPY positions. So I'm going to go ahead and type that in, and we see that we go from a positive 5 to a minus 21. What that tells me is that relative to the movement of the SPY, I'm actually bearish overall in my portfolio. What that means is that if the SPY moves down, my overall position will benefit in terms of profitability. So how can I make adjustments to this position then? Well, in that case, we're going to switch over to the Analyze tab, and we're going to do some analysis on the overall position. Rather than looking at an individual position, which I have here, I'm looking at the calendar spread that I have on, I'm going to change from a single symbol to portfolio beta weighted. And we already have the SPY in the chart, so here we're looking at the overall position and how it looks relative to the movement of the SPY. So we see that our range of profit right now is right in between 101.27 and about 107. In fact, if I do my set slices, I can do a set slices to break even on the October expiration, and we see that we have a range of profit between 101.27 and 107.04. Now the other thing that I can do is I can look at my current price, which is right in the center, so I can go ahead and add a slice that is my current position, and we see that right now we have a lot more range of profit from the current price to the lower break even than we do from the current price to the upper break even, and that's reflected in our overall negative delta. So the question is, what can I do to my overall position that might help raise the range of profit on the upper side? If we assume that the market's going to resume its upward march, then we would probably want to compensate the overall portfolio by making it more bullish as opposed to more bearish. If I thought the market was going to pull back and continue to move down, then I probably wouldn't do anything. I would leave my position as is and wait for the move down, or I would add to my bearish position. In this case, though, I want to start considering what I might do, assuming that the pullback has completed and we're going to start seeing some more buying come in and a resumption of the upward move. To do that, what I will do is add a simulated trade to the overall position. So I click on the Add Simulated Trades. We have the SPY up already because of the portfolio weighting. And what I'm going to do is I'm going to pick a position with a probability of success of Well, here we have a probability of expiring in the money of 35.5. What that means is I have roughly a 65% probability of success, just short of 64.50, I guess. So what that tells me is that I have a pretty high probability that this will be a successful trade. What I'll do is do a sell vertical. Then I want to adjust my lower strike to make it a 100. That'll give us a $2 wide strike, single contract at this point. Let's look at what that did to our overall position now. What I want to do is I want to compare with and without the simulated trade, and we can see how that's affecting our position. Without the simulated trade, we still have our current break-even price, and our maximum profit is going to be just over 250. Now when I add that simulated trade, we've slightly adjusted our position, our break-even points up. We can see that by the fact that these lines have moved away from the dashed line. These are our current break-even prices. So if I was to add one more contract to the position, we see that we've added even more potential profit to the position, but we've raised our upper break-even point to what is that now? That is 107.36. So we've added even more potential room to the upside on that position by selling a vertical spread. And I can continue to play with these numbers. I can add another position. What we see as we start adding more positions to the put side is that we now are adding additional risk that we may not want to take on. So you have to realize that every time you uh, uh, adjust your risk in one direction, you've added risk to the other direction. So you have to always be kind of balancing those things off with where you expect the market to move. If I was more bullish, then I'd be willing to accept some risk to the downside to minimize my risk to the upside. Vice versa, if I wanted to adjust my position and minimize my risk to the downside, then I'd be adding risk to the upper side. So we just have to realize that anytime we add a position, that we're manipulating the risk in some respect. We can't get rid of it altogether. All we can do is shift it from one direction to the other. So on Monday, we might look to see a vertical spread position being put on. In this case, it would be a short put vertical spread on the SPY. And what that would do is it would potentially adjust my delta position from the minus 27 that we had to about -1, as we see here in this little box. So that's kind of a quick view of how we can do some analysis on the overall portfolio position. I hope that's been helpful, and I hope that you've gotten a better understanding of how to use the Analyze tab as well. I hope you found this video helpful. Successful options trading is not just a matter of knowing how to construct a trade or how to enter or exit the trade. Successful options trading is built around a trading system that includes a trading plan with rules for selecting the stock or ETF, rules for selecting the options, rules for entry and exit, and rules for money management. These elements help produce consistency, and that is the #1 attribute of successful options traders. For more information on options strategies, building an options trading system, options broker reviews, and more, please visit www.successwithoptions.com. Thank you and happy trading.